shared. Bob?
Thank you, Chris. I need to start with a spoiler alert. I'm going to say bad things about the income tax. Prepare yourself. It will not be pretty. But it's also not personal. I say that because I look around the room and I see many dear friends who I know are true believers in the income tax. They want to like it. They believe in it passionately with fervor. They think the income tax is a positive force for all of humanity. I am here to just pop that balloon. My boss is one of those people who believe in it passionately. What you're going to hear from me is that the income tax, for lack of a better word, is a bad tax in the economic sense. But that is not to say it isn't necessarily a good tax in the political sense. I totally understand progressivity and fairness. Progressivity in the income tax, really, if you think about it, it's part of the modern social compact. People just aren't going to buy into the nation state if they think it's not fair. And so you need progressivity. I get that. But it can be good politically, but bad economically. That's where the conversation's going. And that's why we are being so bold as to not necessarily predict the death of the income tax, but certainly hint at its demise, decay, and just disgrace. Notice, if you happen to have a copy of Tax Notes International, on the back of it, there's an advertisement for this event, a poster, if you will. And we had a choice when we were doing the art design. We could have gone one of two ways. We could have had a very happy-looking birthday cake. After all, 100 years is a big deal. It should be celebratory. Bravo, income tax. You've done it. You've made it to 100 years. We didn't put that on the poster. We used a tombstone. Yes, yes. Rather a ominous, macabre visual reference, Chris. But, I'm not going to say I had a hand in that, but it's more or less consistent with what I'm going to say. Also, as another preliminary remark, when I say it's a bad tax, you have to understand the context here. I'm not suggesting that I'm not talking about things that can be easily fixed. Let's say I happen to not be a big fan of the current treatment of carried interest. Don't like it, don't think it works, bad. That's not what I'm talking about when I say the income tax is a bad tax economically. Congress, if they wanted to, today, could change carried interest. House could pass it in the morning, Senate could approve the legislation in the evening, Obama could sign it tonight. We could fix that. I see my boss, David Bernori, over here, who I suspect is not the world's greatest advocate of the itemized deduction for state and local income taxes. That could be fixed. So when I say the income tax is a bad tax, I am not talking about things that can be patched. We're talking more about the foundation of the house, rather than, changing the color of the shutters or anything like that. So let me begin after I have my Marco Rubio moment. At least I don't have to go off camera. All right, there are two reasons why it's bad. I'm going to refer to them as the purist's objection and the pragmatist's objection. And I could go on forever, but I'll try to be brief because we want to hear what you have to say. The purist's objection is that the income tax is a bad tax because it deters capital formation. We need capital stock. Every sovereign nation on earth needs capital stock. If you don't have capital stock, what will you get? You will get stagnation. What is the lifeblood of capital stock? It's savings. People need to save. Savings, capital formation, that gives you economic growth. That gives you job creation. I'm saying all this and I believe it, but I'm not even a supply sider. So these are not crazy arguments. We need this. The good news is if that you are an individual participant in the economy, you have a great incentive to save, which is good for capital stock. You don't want to be broke when you retire and you're old. So let's say you earn $1 of income. What are you going to do with it? An economist would say you've got a choice. You might think there's a million things you could do with that dollar of income, but really there's only two. You could consume it now, or you could save it. And saving it really means you're consuming it later because all money will eventually get spent, or so we're going to assume. So the choice of how you spend that dollar is really between present consumption or future consumption. Future consumption is good. That helps maximize net welfare across the economy. We want that. And people have an incentive to do it. But then you layer the income tax on top of this scenario I'm describing. And all of a sudden, you've changed the incentives. You've distorted market choices. You've given people a reason not to save, but to spend now. That deters capital formation. That's bad. That is adverse to maximizing overall national welfare. So the income tax actually sort of cuts in the exact opposite direction than it really should. Now, we do not have time today to have a graduate level course in macroeconomics. And if we were, I certainly would not be the person to teach it. I look around the room and the very high pedigree of intellectual talent here, I would not be teaching that course. But I do want to take the liberty of reading a very, very brief statement from a book that one of my colleagues, Dr. Martin Sullivan, who also works for Tax Analysts, wrote. And I'm going to paraphrase him here. I'm not sure if Marty's here, so I was going to say I won't embarrass him, but if he's not here, I'll embarrass him all I want. So here we go. The overwhelming case against the income tax. The title of this chapter may seem a little overbearing. After all, aren't there two sides to every story? Well, when it comes to the economics, not the politics, but the economics of the income tax, the answer is a great big fat no. There is no economic justification for its existence. This statement boils the blood of liberals, and it surprises most of the general public. It's not often discussed. Sorry to hurt people's feelings, but there's no escaping the truth. And this is almost universally accepted among economists, both Republican and Democrat. In fact, of all the bad taxes out there, economists consider the income tax the most harmful to growth of all. Now, I have taken, that's the end of the quote, and I'll calm down a little. This is a form, not a sermon, I'm told. I've taken a bit of a liberty here, in full disclosure. Dr. Sullivan wrote that passage specifically describing the corporate income tax. And my nuanced enhancement here is to, by extrapolation, apply it to the full income tax because the income tax does reach savings, so the concept is valid. So that, in a nutshell, is the purist's objection to the income tax. There's one more. There's the pragmatist's objection. What's that all about? We'll go back to that $1 of income we were talking about before, and instead of thinking about how you spend it now or later, think about where it comes from. What are the sources of your income? Every single dollar that you report on your tax return comes from somewhere. And you might think there's a lot of sources, but really there's two. There's income from labor, and there's income from capital. That's where it comes from. Income from labor, what's that? That's going out, working, that's your paycheck. Income from capital, that's when you save, you invest. We're assuming here that you don't save and put the money under the mattress. Very, very bad. You have to go and put it to a productive use. That will produce dividends. That will produce interest income. That will produce rents. That's income from capital. Now, when we look at this, we're struck by something, that one of these things is very mobile, and the other, not so much. Income from capital, very highly mobile, especially today in the era of globalization. Everyone talks about globalization, and some people say it's been going on in various forms since Marco Polo and the early explorers. So it's always been with us. But today it's accelerated, it's heightened. Why is that? The last few decades we've seen the free trade movement. We've seen the eradication of currency controls around the world. There's a global network of bilateral tax treaties that reduce the incremental withholding rates when you try to get money out of a country. In other words, if you're lucky enough to invest in a foreign country and earn money there, it's really cheaper to pull it out. So goods and services, easy for them to go across borders. If you make money, easy for that to come back. All of this means that capital today is very highly mobile. Different dynamic than what you had in the 1950s. Joe here, I might talk to him later about this point about how new is tax competition, how new is capital mobility. He might say that capital mobility isn't that new, and I'm not going to argue with him because we have the preeminent tax historian in planet Earth and therefore the cosmos right here, so I'm not going to argue with him about history. But I will say that you tax it too much, it will flee. This is an old proverb. I think it goes back to the ancient Romans and Cicero, who said, if you want more of something, subsidize it. If you want less of something, tax it. They understood this 2,000 years ago. But that assumes the it that you're taxing can leave. And capital sure as hell can. I mean, you could have $1 million in Singapore right now, and by 11 o'clock, you could have that $1 million in Hong Kong. It's doable. This stuff happens. Labor. Is labor as mobile as capital? No, it's not. It's really hard to move around. You know, a family in suburban Washington is not going to just pick up and leave, move to, you know, Arizona because they might get a better tax outcome. There's your job, there's your mortgage, there's your rent, there's your family connections, there's your social connections. You're going to pull your kids out of school just to do that. So capital, highly mobile, labor, not so much. There are some exceptions, I know. Let's say you happen to be a professional golfer. Let's say you happen to be pulling in $60 million a year in prize winnings and commercial endorsements. And let's say you're living in high-tax California and you'd prefer to be living in no-tax Florida. Yes, you could move, and those barriers aren't so meaningful to you. So, yeah, Phil Mickelson probably needs a better tax accountant. And for the 1%, sure, there's some mobility, so it's not an all-or-nothing thing. But understand the capital is mobile. Now, what does this mean for the income tax? I have a little exercise here, and it's going to involve some questions I'm going to ask you. I'm going to pick on a country, the United Kingdom, our British cousins, okay? And I'm going to ask you to think about their tax system and their tax rates. And I'm going to ask you, is their particular tax rate globally competitive? And I want you to think about whether the answer is yes, it's competitive, no, it's not. That's it. A, it's competitive, B, no, it's not, or C, we can't tell. The answer is indeterminable. Okay. A few years ago, the UK tax rate, we'll use corporate tax rates just to make things easy because you don't have all the brackets that you have on the individual side. And we're going to talk about statutory rates, even though I know full well effective rates have nothing in common with statutory rates. Indulge me, it's a teaching exercise. A few years ago, UK had a 30% tax rate. Is that 30% tax rate competitive? Think about it. Yes, no, or can't tell. Well, compared to us, it seems competitive. We have a 35% corporate tax rate at the federal level. You got to kick in something for the states. What is the weighted average? 4.7%? Let's just round up and make it 5. So 35 plus 5, 40% US tax rate, 30% in UK. You might be inclined to say, sure, that's competitive. Ah, but wait a minute. Just across the Irish Sea, there's Dublin. What do the Irish have? A 12.5% tax rate. So the answer, if you didn't figure it out, is C. All the intelligent people in the world cannot sit down and look at a tax rate or an element of a tax base and declare it to be inherently, definitively, per se, competitive. Competitive has no name or no face. You don't know you've lost capital until its sprouted legs gotten up and left the room. That's the nature of the exercise here. That's how the race to the bottom works. Time goes by. What does the UK do? They want to compete against the Irish. They lower the tax rate, first to 28%, then to 26%, then to 24%. I think now they're at 23%. You see the direction they're going? In a few weeks, April 1st, it goes to 22%, and then a year from now, April 2014, it goes to 21%. So the question to you, a 21% corporate tax rate, is that competitive? Yes, no, or there's no way we can tell. Well, 21% is almost 20%, and we're at 40%. We're talking about a tax rate that's half of our tax rate. It's got to be competitive, right? Well, no, because, you know, capital is still going to go to Ireland because they're at 12.5%. It doesn't end there. It keeps going. Tax competition is a race that has no finish line. British industry groups go to the Houses of Parliament. They say they want what? A territorial tax regime. So this isn't rate manipulation per se, because maybe they thought for political reasons they could only do so much of that. They wanted, they asked for, they begged for a territorial regime that basically exempted foreign source income. Now, in theory, those foreign profits will be taxed by the source country, but if the source country somehow is a tax haven, it isn't getting taxed there. So they get a 21% tax rate. They get a territorial tax regime. Not enough. They want more. Tax competition never ends. They ask for a patent box. What in the world is a patent box? It's an imaginary box where you take corporate profits and you put them there if they happen to be related to royalties paid on the exploitation of a commercial patent. Well, what is the rate associated with the UK patent box? It is 10%. I ask you, same question, a 10% tax rate in the UK patent box. Can we say that 10% is competitive? Well, it must be, right? 'Cause we're at 40. Okay, now we're talking 10. That's a quarter of our tax rate. And significantly, it's dropped below the Irish rate. It's probably a big deal with the English and the Irish, right, that they've finally got a lower rate than they do over in Dublin. Certainly, that must be competitive. No, the answer is still C. It's indeterminable. You can be Einstein. You can be the smartest person in the room. You still can't say with any degree of reasonable certainty a certain rate is competitive. It's because of the structure of the income tax. You know why 10% isn't competitive? Because they look across the English Channel and there's a place called continental Europe. And in continental Europe, there's a country called the Netherlands, and they have a patent box. And what's their rate? 5%. That is the essence of our sad little story about the income tax. We've reached the point where a 10% tax rate isn't working. British pharmaceuticals are threatening to get up, leave, go over to Amsterdam where they can have a 5% corporate tax rate. Where does it end? Do you go down to 0? It doesn't end there, because what's a negative tax? It's a subsidy. You could actually subsidize this type of activity. Asking when tax competition stops is like asking when gravity stops. It ain't going to happen. And it's because of what's being taxed. To the extent you're taxing capital, you cannot get away from this. You'll never get away from it. That's why you see these trends that are going on in the world. And I'm just about to wrap up. This is my final point. You know, people talk about trends, and they say, look at what's happening. In the UK, just like every place else, corporate tax rates are going down. The tax base is getting contorted with things like territoriality. Those have to be the trends. I say, boulder dash, that's not the trend. Don't let anyone tell you the trend is just that rates are going down. That's half the story. What's happening is that all over the world, countries are purposefully dialing down their reliance on the income tax as a revenue tool, and contemporaneously going out and getting an alternate revenue source. It isn't just about lowering rates. I mean, the government as a size of GDP and the tax take, those things are increasing. At the same time that rates are coming down and tax bases are getting narrower, a lot of countries, the tax collections are going up. How can that be? Other countries have found an alternate revenue source. And they're doing that because of this, the tombstone. Okay? Hence, that's why we have the tombstone, not the cake. Isn't a pretty picture. Do I think the corporate tax is going to go away? No. It serves this political purpose, which we absolutely need. As I've said, it's part of the social compact. You have to have fairness and progressivity. But eventually, you're looking at an alternate revenue source. And that's my